Welcome to Investors Guide. I'm very excited about this show because we're getting emails from younger and younger investors, 24-year-old, 23-year-olds writing in, asking us how to invest their money in mutual funds, and that makes us so very, very happy. Well, if you have a young person at home right now, grab a pen and paper and write down some of the advice you hear on this show. It'll be useful for anybody who's just starting off. If you have a question, you can send us an email. Our email ID is at the bottom of your screen. On the show this week, a very young man would like to save for a holiday he'd like to take in 2 years and also for his retirement, so we're going to help him out. In our product review, we'll find out if the DSP Blackrock Equity Fund deserves any more of your patience at all, and we'll tell you what to keep in mind while buying a term cover. All right, let me invite Kumar into the show. Thank you so much for joining us. A lot of young people writing in with, a lot of questions. One of the things that normally worry young people about investing their money is, possibly making mistakes, and they leave a lot of money then in their bank accounts. They wait till it accumulates, and then they start to invest it. I know that your main advice to anybody young right now is to just keep it simple. But if you were to give them a step into this equity market that we are seeing at this point, what would that be?
I think, there's 3-4 simple rule which, one, keeping it simple. And those 3-4 simple rules to be followed are, even at the cost of, sounding like a stuck record, I would like to repeat it. Get started with a conservative vehicle. Never invest lump sum. Invest only your long-term money into anything linked to the market, and not invest lump sum. The corollary, the other side of it is that always invest in a staggered manner. Always average your investment. So if you are not investing your short-term money, if you are only investing on a month-on-month basis or on some regular structured investment plan, so most of your worries will be taken care of.
Here's my piece of advice to all the young people watching. I know in this day and age of the internet and smartphones and everything available at the click of a button, that we have become a sort of impatient generation. What I want you to do is to simply teach yourself to have patience when it comes to your investments. Don't expect things to turn around and flip about and give you something to brag about in less than a week or in less than a couple of months. Only, like Dhirendra said, put in your long-term money, which means you have to give it 10 years to actually give you returns. You can't expect something to turn around immediately, even if you want it to be an instant investment. So if you keep that in mind, like Dhirendra said, keep it simple, do your research, pick an equity diversified mutual fund and start an SIP. You should be okay and you will not be sorry. Let's move on to our portfolio question. Well, 29-year-old Varun Goyal has written in from Gurgaon, Dhirendra. He has an income of 89,000 rupees a month and he saves about 44,000 rupees. Now, these are his goals. He wants to buy a home worth 1 crore rupees in the next 5 years. We have to wonder what it's going to cost after 5 years. He also wants to put aside 4 crore rupees for his retirement and 5 lakh rupees for a foreign trip over the next 2 or 3 years. And he sent us a list of his investments. He has 50,000 rupees going into the PPF, and that's going to make us frown. He has a term insurance policy and an RD of 20,000 rupees a month, medical insurance from his employer, and stocks of 4.5 lakh rupees. He wants to now start investing in mutual funds. First of all, I'm not so happy about the PPF, and I'm not so happy about the 4.5 lakh rupees in stocks when he doesn't have any mutual funds, Dhirendra. What would you recommend he does? If you look at his portfolio right now, I'd start him off with a health insurance policy that he must buy on his own. What else can we do to tweak his investments around?
Varun is a fixed income investor going by, the kind of money going into his PPF as well as his recurring deposit, 20,000 rupee. He really needs to reorient himself, and it is not that easy. Somebody who has been, who has configured all his investment in a fairly risk-averse way. And he has to really ask these very basic questions that what he intends to achieve, will it be enough? The method that he has followed so far, will it be enough to achieve all his goals? And he should just follow some prudence in his, the goals which he is aspiring for. And they're fairly achievable given his scale of savings, 2,40,000 rupee going into recurring deposit. He should prioritize things. One is he should look at the tax-saving investment that he needs to make. He should look at an emergency fund, and that money should be in a term deposit or in savings bank account or a liquid fund, and that's it. The rest of the money should find its way into a tax-saving fund to the extent he can avail Section 80C, and maybe just keep his PPF account live for the heck of it, and stop making any substantial investment, and discontinue his recurring deposit. All incremental savings that he can do over the ATC, after availing a Section 80C entitlement, that money should find its way into an equity fund. And this plan, as and when he is able to find that the worth of his capital, his savings or accumulation, is 25%, 30% of the value of the house which he intends to buy, he should buy it. That can happen in 3 years' time, and there are a lot of variables around that. One is that home prices may not go up, home prices might go down. Likewise, in both these cases, or his investment performance may be maybe outstanding, and if he's planning that he needs the house in 5 years, and if his accumulation actually is good enough in 3.5 years, he should well go ahead and actualize his goals.
All right, so this is the advice you're getting. Stop the contribution to your RD and to your PPF as far as you can. A lot of us assume that the PPF gives you a guaranteed return, but it doesn't really. The government sets the return on the PPF every year. So if you're assuming that you're going to get close to 8.5 or close to 8.45% for the rest of your life, that might not actually be true. That's something that will vary. So consider that when you're making that choice. Then he'd want to put some money in mutual funds now. He sent us a list of funds he'd like you to approve. The L&T India Value, Axis Long Term, HDFC Balanced, L&T Large Cap Fund. I approve Growth and Other Services. I approve Value Discovery. And he has a surplus of 6,000 rupees he'd like to allocate. Again, when I'm looking at the funds, I don't know why he needs to go so specifically into Growth and Other Services. Would you just like him to pick up one of our portfolios instead?
Yeah, I would like him to pick one of our portfolio. But more importantly, if I have to just please him to make a selection from his investment, the ones which he has chosen, I would like to pick Axis Long-Term Equity as his tax-saving investment, and maybe ICICI Prudential Value Discovery Fund as his other long-term equity investment. And these two funds will be good enough if he's disciplined about it. And I would urge him to, seriously consider a part of his PPF money coming into this, and he should take a 5-7 years view while doing that. All
right, you can pick these two funds for the next 5 or 7 years and move some of the money that's going into your PPF and your RD into these funds. Alternatively, you can use our aggressive growth portfolio that's on your screen right now, and write back to us if you need any more help. Get that health insurance, though. Do it before you do anything else. It's not enough to just have health insurance from your employer. Very quick question from another young investor. 23-year-old Pratik Jain has written in. He has an income of 33,000 rupees a month. He's been investing, Dhirendra, 1,000 rupees in the PPF and 3,000 rupees in mutual funds. He wants to know if he's on track right now. He's using UTI Equity and iProof Focus Blue Chip. He wants to add one more SIP, and he wants to know which one he should add. Should he be using a balanced fund? He's good on short-term options right now. He has some assured returns. He wants tax saving at this point on his investment. So if you were to give him a tax-saving mutual fund, obviously the balanced fund won't do the trick here. He'll have to pick a conservative tax-saving fund. What would you recommend for him?
Why worry about a conservative one? Because you are getting locked into for 3 years anyway. So I would say that he should his two funds, his current investment in these two funds is good. He should not try to add any more fund. He should just increase his allocation here. And a good tax-saving fund could well be Franklin Tax Shield or ICICI Prudential Tax Plan or an Axis long-term plan. He can choose one of any of these.
All right, so the 3 tax savers that Dhirendra just recommended are on your screen right now. And if you would like us to answer your question, you can get in touch. Email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide on ET now. Thank you for staying with us. It's time for our product review, and we're looking at the DSP Blackrock Equity Fund. Avan will take you through those numbers, although they seem a little concerning. Avan, take us through what the last 1 year has been with the DSP Blackrock Equity Fund.
Thanks, Faye. The fund in focus this week is the DSP Blackrock Equity Fund. Launched in the year 1997, this fund has had a good long-term track record. But how does its performance look in the recent past? A quick look at its performance chart over the last 5 years shows that the fund has not been up to the mark. You'll see that the red line, which is the fund, has marginally performed better than its benchmark and its category. While the fund fared better than its peers in a market downturn, it hit a rough patch in the year 2013 with a return of less than 1%. The following year, the fund's performance improved with a return of 53%. You'll notice a similar trend in the fund's trailing returns as well. While the fund has underperformed its category in the 1, 3, 5 and 7-year periods, its return over the 10-year horizon is promising. Should you be worried with the fund's recent underperformance if you're a long-term investor? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that update. Dhirendra, I know you tell us that we should be patient and we should give a fund a chance to recover. But look at the performance of this fund over the last 1 year. Avan was just taking us through those numbers. It's 2 stars on value research, and that even in your book you tell us that after anything lower than 3 stars we should start to worry about. It doesn't hold up by any yardstick. Is it time for us to pull our money out?
I think this fund has been testing the patience for a long time to be a performer. If you look at long-term performance in the last 10 years, it looks at the second best performance. But last 5 years, every year it has beaten its benchmark in most of the last 10 years, except 1 or 2 years. But looking at relative performance, the kind of options investors have in this category, a multi-cap, this fund takes risk, and it has not been able to reward investors and consistently for last 3-4 years. So I would say that, of course, last year was an outstanding year for the fund. Despite that, this fund has been a test of patience, has been disappointing. It has either and has consistently been a below average relative to other funds in the category, despite beating its benchmark. So I would say it is time to give up on this fund. Yes, I do say that don't look at 6 months, 1 year or 1.5 years. Given that if a fund has done consistently well or on all the inflection points, yes, one should not. But I think there isn't a case of holding this.
Well, Dhirendra, if I were to pull my money out of this fund right now, what would you recommend I put my money into within that same category?
Looking from this category, there are few promising funds. I would say Franklin's High Growth Companies Fund and L&T Value Fund. They're the most promising in this category.
But Dhirendra, I'm going to ask you also about the entire fund house of DSP Blackrock. There was a time, I remember when we started this show about 7 years ago, when it was extremely promising. There would be a DSP Blackrock fund in almost every time we talked on the show, in a couple of our portfolios as well. It sort of has seemed like the entire basket has slipped from favor. Tell us what's going on with all of these funds, and if I'm an investor holding any type of DSP Blackrock equity fund, should I step back and look at it for a moment?
Yes, it requires an objective look at, and there is something which must be driving the lack of performance here. The only one thing which stands out in this fund family is the micro cap fund, which should be a very peripheral part of anybody's portfolio. But all other mainstream fund, all the stalwarts in the fund house, they have struggled. They are not top of the mind. They have not been consistent performers, and I think it has something to do with the way they are conducting or the way they are actually conducting their investment management. Because when I look at DSP Blackrock Top 100 or the DSP Blackrock Opportunity or this fund, which is a very old fund, it's among the first fund launched from the family, I think they need to. And DSP was not supposed to be a great fixed income. You don't make a name by managing a fixed income fund. Equity was the forte, and they have with all their mainstream fund. They have definitely lost. They don't come. They're not first among the set of funds we look at in each category.
Well, Dhirendra, DSP Blackrock Equity Fund, you give us a sell call on that fund. Give us also your rating for Investors Guide.
I would say that I'll still give it a 2-star fund simply because it has beaten its benchmark fairly consistently, but it is in the bottom or I would say the third quartile in most of this time period. Fairly consistently over the last 5 years.
2 stars for the DSP Blackrock Equity Fund. Dhirendra saying 2 very, very important things. I'm going to reiterate. If you're invested in this fund, it's time to pull your money out. Secondly, if you're invested in any DSP Blackrock Equity Fund, it's time to review that investment and decide based on what other funds have done within that same category, which you'll notice a lot of other funds have done far better. So it might be, it might be the time for you to pull up your portfolio, take a look and see if you have a DSP Blackrock fund in your portfolio, and then decide what you want to do about it. Then the one very quick question. Puneet Arora has written in, he wants to buy his own house in 8 years, and that's normally an investment, goal that all of us have. He tells us he can invest 20 or 25,000 rupees a month towards that home. He wishes to save on tax. He wants you to recommend a couple of mutual funds that he can invest in so he can buy that home as soon as possible. What would you recommend, Dhirendra?
I would say that I would recommend the same basic method to be followed. If you're the first-time investor aspiring for a house or any long-term goal or medium-term goal, he should start conservatively, because for every investor it is extremely important to reconcile with this new method of investing if you have never invested in any market-linked investment. So get started with a balanced fund, do it for 1 year, and do it in a disciplined way. Don't get distracted by the noise in the market. When you see that the market has gone up by 500 points or gone down by another 500 points the next day, don't worry about it. Be at it, keep doing it for 1.5 years. Take a stop. Then that will be the time when one should revisit. So get started on board with a balanced fund and don't get distracted for next 1.5 years. Never make a lump sum investment. Do your SIP.
All right, so keep it simple. Start investing today. Balanced funds are on your screen right now. Take down those names, start investing in 1 or 2 of those funds, and we're here to hold your hand, so you don't have to worry about anything. Start with that amount of money, and as you can afford to put aside some more, and we'll help you even buy that house as you get closer to that goal. Dhirendra, thank you so much for joining us on the show and answering all of those questions. As always, it's a pleasure to chat with you. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. This is our special insurance segment. We're going to answer all your questions on insurance. So Gajendra Kothari has joined us. Gajendra, thank you for standing by. Our first question comes in from Rohit. Rohit tells us he's retiring in a month and he has a son who's dependent on him with special needs. These are his financial details. He has 1.5 crore rupees in savings. He has a fixed deposit of 50 lakh rupees. He has balanced funds of 50 lakh rupees, MIP of 50 lakh rupees, and post office monthly savings. He's also been saving tax using ELSS up till now. He has medical insurance from his employer. He wants to know now if he should buy a term cover at this point. Well, Gajendra, it's going to be prohibitively expensive for Rohit at his age to buy a term cover. But would you recommend it?
Since your current expense is around 40,000, if I take 6% inflation also, so after 20-25 years, it will be roughly around 1.5 lakh rupees a month, which would still be able to meet from your corpus. So I think from this corpus, easily you'll be able to achieve 40,000 rupees kind of monthly pension which you would require, and increasing. So I don't think here you have to worry. Of course, from your portfolio, I can see currently you are a little more risk averse. You don't want to take high risk. But since you have a time horizon, I may recommend that maybe 10-20% of your FD portfolio or MIP portfolio can be shifted to a diversified equity fund, because you have time on your side. The beauty about that is that in the long term you can expect around 12 to 14% kind of return, and that too after 1 year it's tax free. So that is really good. Secondly, you mentioned that you have a health insurance from your employer for you and for your wife. Since you'll be retiring shortly, then the biggest question mark will come on your own health and your spouse's health. So in case if something were to happen to you, then you are really dependent on your own corpus if you're not having any health insurance. So I would strongly recommend right now that to buy a good health insurance for a decent cover as high as possible, like 15 lakhs or 20 lakhs, because we never know how much one can spend on medicals, if required be. With regard to term insurance, I don't think you require a term insurance cover. And again, it's difficult for most companies to give you, because since you're just about to retire, most companies will hesitate to offer you term cover, and the premium also will be very high. So you can skip buying a term insurance, but you should have a decent medical insurance cover, and your portfolio is looking good per se.
Pramod JB has written in. He wants to buy health insurance for his 63-year-old father who's diabetic. He's looking for a cover of between 1 and 3 lakh rupees, and he wants you to suggest what should he do. Now, Gajendra, it goes without saying it's going to be extremely expensive, but like we suggest on this show, everybody must have health insurance. And of course, there are specific policies available for senior citizens. Can you help him figure out which of those policies he should be accessing?
I guess it's little late now, to get an insurance cover for your father, because of course, based on his age, and also he's having pre-existing conditions like blood pressure and diabetes. Very few companies in India offers plan for these ailments, but there are a couple of companies you can kind of approach them. Apollo Munich has a super energy plan, which is meant for blood pressure and diabetes patients. You can check with them, but if they're on insulin, then again he will not get it. If he's on a regular medication, he might certainly get it. The premium will also be higher compared to other policies because the risk involved is higher. So for a 3 lakh cover for your father, the premium would roughly be around 39,000 rupees. But chances are there you may get from few companies. So there's no harm trying it.
Last question comes in from 31-year-old Deepak Seth. He has an income of 1 lakh rupees a month. He tells us his spouse and parents are dependent on him and he wants to buy a term cover. What amount should he be covered for? But Deepak, first of all, I'd like to give you 2 thumbs up for deciding to buy a term insurance cover. That's the first step. So once you've gotten till there, it's very easy to now figure out what sort of a cover you want. The thumb rule is about 10 times your annual income, but go as high as the insurance company will allow you to. I'll tell you why. Because your income will keep increasing and then you don't want to have to buy another policy to make up that difference. But Gajendra, would you recommend what sort of policy he should be buying?
So since you're earning 1 lakh rupees a month, basically you're earning 12 lakhs. So as per many companies' guidelines, you can get up minimum 10 times and up to 20 times of your annual income as the sum assured. Since you already mentioned that your parents and spouses depend on you, it's a good idea to go for term cover because that's the cheapest form of insurance. So again, for your age, you'll be shelling out some close to 12 to 15,000 rupees per annum for 1 crore cover. Again, I would recommend to go for the online term plans compared to offline because both are similar, but here you are bypassing the agent. And it is cheaper to your pocket by 30 to 40%. So that you can go ahead. You can choose any company whichever you want or where you have comfort factor with. But of course, each company has got different varieties and different product details. So you have to analyze those and then decide which is right for you.
All right, Gajendra, thank you so much for joining us and answering our questions. Now, if you're having trouble buying an insurance policy, get in touch with us. Our email ID is on your screen. You can reach me personally on Twitter whenever you want. It'll be my pleasure to hear from you. Anything to do with your money, really, whether it's your credit card, it's your bank loan, or it's your savings account. Get in touch and we'll try and help. Tune in next week to catch the show. Thanks for watching.